Hey, what's up guys? John here. Jerome Powell just came out and said that there will not be any interest rate cuts until 2025 or 2026. We look at the state of regional banks right now. We look at what's going on right now with interest rates, home loans, mortgage loans, credit card interest rates, auto loans. It's absolutely nuts. And if we continue down this road of hiking interest rates and keeping them elevated for the next couple of years, we're going to see an absolute bloodbath in the housing market. Now, if you want to invest in real estate, the time for you to pick up some really great deals is probably right around the corner, because we're going to start to see a lot of people that are just desperate to get out from underneath this situation. Now, please hit the like button. Hit the like button. YouTube will share the content. If not, it's cool, whatever. Also, today's video is sponsored by GreatCreditFast.com. GreatCreditFast.com. If you want to fix your credit to position yourself to invest in the greatest wealth transfer of all time, we'd love to give you a free consultation at GreatCreditFast.com. Take a look at this. So, Powell says Fed rate cuts are a couple years out. A couple years, right? It's very interesting because when you start to look at why he's saying this, why rates need to stay here, you're going to see a whole new landscape that's going to shift, and it's going to become very, very challenging for landlords and property owners. So, and I did the video 3 days ago, landlords, they're about to change everything. And the reason I did this video was because I was looking at their data and their information. They were blaming landlords and property owners for CPI, inflation. Now, many people might agree with that and saying landlords did price gouge, right? Many people might not agree with that. I just want to look at things clearly. Everything has increased. I don't know anything that has stayed at 2% inflation rate over the last couple of years. Healthcare, auto insurance, home insurance, food, coffee, gasoline, everything has increased. Everything. It's been crazy. But you also look at, what a lot of landlords went through. A lot of them went through eviction moratoriums, or they had tenants not paying rent, but their mortgages were still due. You had increased insurance and increased property taxes, increased repair costs. A lot of tenants and a lot of landlords both went through their fair share of problems the last few years. But looking at this, we can see what's going to happen with landlords. In fact, I did a video 2 years ago saying that what I believe is happening is that real estate assets, stock portfolios, people are looking at crypto, they're looking at all these different investments, and everyone's thinking that they're a genius, but it was really based on artificial currency that was just printed, money that was printed into the system, record low interest rates, and that we were being set up for the greatest rug pull of all time. And I said in that video, we'll look back on this and see if I was right, but I think that we are in the greatest rug pull of all time. This is what I said.
That's an idea that I have. I wonder if it'll come true. We're going to look back on this and say, like, hey, maybe John was right. Maybe he was right.
This was July 19th, 2021, right? This is what we're stepping into. We've been stepping into this last year, these gradual interest rate hikes. But when we look at this, you can see this. So Federal Reserve Chair Jerome Powell called out a lack of progress on bringing down rental costs on Wednesday. You're just not seeing a lot of progress, not the kind of progress you want to see. Although experts have forecasted a slowdown in rent increases, little progress has been recorded so far in Consumer Price Index. Annual rent inflation stood at 8.7% in May, while shelter costs overall were up 8% year over year. The rise in housing costs accounted for more than 60% of total increase core CPI. Now, in this video that I put out, the data that they showed 3 days ago showed 70% of CPI. So I feel like they just kind of like pull these numbers out of nowhere sometimes. So you can see the conversation here. The only cure to inflation is bringing down the cost of housing, right? If you go on AIDSHealthFoundation.com, they say right here that this group of people, they need rent control. Now imagine that. Imagine certain groups would get rent control. They would get certain protections, and then other groups wouldn't get that, right? But this is kind of like, and this is a California-based company. Now, this company is a multi-billion-dollar company, and this is along the lines of conversations that are being had nationally. So you can kind of see what is happening. Like, it fuels inflation or homelessness. Sky rents fuel homelessness. This is the same conversations that we're starting to see here. Rents, corporate greed, right? And then they show you a fat white guy smoking a cigar like he's, has all the money in the world. When in fact, most landlords are small mom and pop landlords. 76% of the entire multifamily and rental housing stock in America is owned by mom and pop, mainly small business owners, accounting for over 20 million housing units. So they're not these, greedy landlords, most of them anyway. And so when we're looking at this dynamic, what we're going to start to see here is we're going to see a couple of really big changes. We're going to see a lot of property owners that bought properties thinking, hey, this is going to be my home for the next few years, the next 5 or 10 years, and then lose their job. They can't afford the insurance premiums. They can't afford the cost to repair the home, or they just relocate back to where they came from 2-3 years ago. But now they have this house that they're underwater on. What are they going to do? They're going to do one of three things. They're either going to stay in the house and rent out some rooms in the house to bring in some revenue. They're going to give the keys back to the bank, or they're going to lease out the house entirely. Now, we're going to see many property owners, millions and millions and millions of property owners asking themselves, which of the three options is going to be best for me? And we're going to likely see a lot of people lease their homes. We're going to start to see rents start to come down as a lot of these national builders can't sell their homes or their developments because those 3% mortgages aren't there anymore. People are going to get priced out. They're going to sell to private equity firms, and they're going to turn them for rent. We're going to see tons of new inventory, retirees that thought they had their retirement tucked away, but now they can't survive off Social Security, and they're going to start renting out their homes. They don't want to sell because if they sell, what are they going to do with the money? They don't know how long that money is going to last in this environment. They're going to start renting out their homes. We're going to see tons and tons and tons of rentals, but it gets much deeper than that. What people are not taking into consideration, many people, there's $2.9 trillion in commercial mortgages that will have to be refied in the next couple years. Keyword, couple years, right? Jerome Powell, couple years. What's going to happen? You look at regional banks. They're holding 67% of that $2.9 trillion, right? So they're holding $1.8 trillion in bad loans because most of these loans are bad. $1.8 trillion in these loans. And you look at what's happening to these regional banks. The media put out all this information that, regionals are delicate. You don't want to have money in regionals. You want to go to the big banks. You want to go to the big banks. SVB, First Republic, Credit Suisse. You start seeing these banks start to topple over. People are like, hey, I need to get my money out. I need to go to Wells Fargo or Bank of America or JP Morgan Chase. I need to go here, right? And so what's happened to these regional banks? They're holding $1.8 trillion in these loans. A lot of them are underwater. They're seeing their deposits reduce. They're seeing consumers that are spending money naturally because of the high cost of living. So they're just continuing to see their deposits suffer, and they have less money to invest. So they're getting less returns. They're looking at their portfolios, seeing losses across the board, credit card defaults, auto loan defaults. These regional banks are in big, big, big trouble. And so as they continue to keep rates elevated, you're going to see all of these people that can't refinance their properties. And how? Why does this work this way? Well, over the last couple of years, a lot of investors in California during the eviction moratoriums in New York, they're like, hey, I need to sell my property. I want to go to Miami. No income tax, high rents. I'm going to go do that. So they would sell their property, do a 1031 exchange, which is where they sell that property and roll the gains into another property of like kind, like a multifamily building for multifamily building, and they would buy a building for a 3 or 4% return. But what happens when they were buying the deal based on the interest rates at that time, but those interest rates are getting reset every 2 to 5 to 7 years in most cases. Well, a lot of these investors are about to get absolutely smacked. Because if you try to refinance a $50 million building that you bought at a 3% mortgage rate and now rates are 7%, that building might only be worth 20 or 25 million. But you only put down 30% on that $50 million building. So maybe you put down $15 million bucks. And you put down that $50 million bucks, you took out a $35 million loan. Now the building's worth 20, 25, 30, 35 million bucks. You would need to put another 30% down on the building based on that current new valuation. So you'd have to strike another check for, 15 million bucks or 20 million bucks just to stay in the deal. People aren't going to do that. They're going to walk away. And so it's going to have a really, really big impact on lending going forward. Moral of the story, lending going forward is going to be challenging. And if you're an investor and you're like, hey, my goal is to invest in real estate. I want to buy a house because I'm tired of, renting. Look, if you want to invest and you want to position yourself, look at what's going on. The only people that are going to get funding, point blank, are going to be ones that have strong income, right? They're positioned where banks are like, okay, this person's offering no risk. Strong funding, they have money in the bank, they have very little debt. Like they're going to be looking for that perfect type of borrower because when things hit the fan, they don't want to take risk. And it looks like things are going to hit the fan. You're going to keep interest rates elevated for the next couple of years. What a lot of people also don't realize is with the stimulus money, the PPP money, and all that money that was put in the system, people just didn't say, okay, I'm going to be responsible. Most people, I'm going to just pay off my credit card debt and I'm going to live below my means. No, people took that money and they signed for a 60-month car payment on a Charger, right? On a C300 Charger for 50 grand or, some big number. They paid 20K over sticker, right? That's what a lot of people did. They used their money for down payments on loans. And now the cost of these loans are going up and the job market starting to come down. So it's going to get challenging out there. There's no doubt about it. A lot of real estate investors, a lot of smart and savvy ones, are going to see this as probably the greatest opportunity of all time, because when there's less capital and there's less opportunity out there, you're going to see the big dogs stepping in. Blackstone, BlackRock, all these big companies stepping in, acquiring all these deals. I'm not saying they're going to buy everything. They probably will buy a lot of it, but smart and savvy investors as well are going to be able to invest if they're positioned right. But honestly, most people probably won't, because I was a real estate agent in 2009 in Los Angeles, and at that time, everyone said, "I'll invest when the market goes down further. I think the market's going to keep crashing," and no one ever really invested. A lot of people, those people started investing in 2014, 2015. So if you want to invest, the time to invest is when everyone's absolutely panicked. We're not there yet. I think that panic's going to set in soon, but that is when it's the time to invest. But from now until then, you want to get everything in line. You want to have very low credit card debt. And right now, you can still do balance transfers. You can still do things to position yourself. But most people won't, point blank. Most people will just ignore it, be like, okay, I'll get to it. But that's what's going to happen. Get your money in line. Make sure you have your credit in line, 740, 750 credit scores, low consumer debt, strong income. Position yourself. This is the greatest rug pull of all time. And I think it's only going to happen. There's probably going to be we're entering a series of rug pulls, but this first initial rug pull is going to be, it's going to be bad for a lot of people. But a lot of people, again, they're going to make a fortune on it. What do you think about this? You keep interest rates elevated for a couple of years. Every single hike, every single month, more and more and more people aren't going to be able to hold on. So what are they going to do? They're going to start fire selling assets. Drop it below. Let's have a conversation about this. Add me on Instagram for content I'm definitely not going to post here. And if you need help fixing your credit, we'd love to give you a free consultation. GreatCreditFast.com. I'll catch you guys in the next video.